Hey guys, it's Mrs. Lamphere again, coming at you with the Unit 3 of Accounting, starting with Section 1 and 2, Equations and Terminology. So in the last video, in Unit 2, we talked about kind of the whole purpose behind accounting. So we're getting all of our financial information organized and we're creating these reports so that we know financially where our business stands. So we can make better managerial decisions. We can truly see if our company is generating a profit or if there's loss in what areas. And again, so we can make some better financial decisions to help our business. So in this unit, we're going to start kind of the whole process of accounting, because there are several steps to kind of generating the numbers and creating the reports. We mentioned an accounting cycle in the last unit, and that many times it's monthly, bi-monthly, yearly, quarterly, and all that. And these are kind of the steps that are taken during that accounting cycle in order to produce the reports that we talked about. So first, you start with the journal, step 1 here, and recording all of the transactions that the company makes. Then we take that information and we post it to the ledger accounts, which today we're going to focus more on the journal entries, but I just kind of want to give you a big overview of, we're going to cover all the stuff in this course. So today, and this unit talks about journal entries. Then we're going to go into posting our journal entries to the ledger accounts and using that information to come up with a trial balance. And finally, we use that then to prepare the balance sheet, which truly shows us kind of the net profit or net loss that our business has. So like I said, this section 2, we're going to focus on recording the transactions into the general journal. So in order to do that, you need to know some technical terms. First of all, we need to get really familiar with the term asset. And an asset is something you own and control. So for instance, some of you already have some assets. Maybe you own a bike or an iPod or a car. Those would all be your assets. They're things you own, they're your property. Then in business terms, we have some assets that are more specific. So we have what are called fixed assets or non-current, okay, kind of interchangeable terms there. These are assets that you own that will provide long-term benefits. So like land, building for your business, or machinery. Your text has a good image for you here. I'll pull that over in a second. So those are fixed assets, assets that are going to kind of last you a longer period of time. Then there are what's called operating assets, or also known as current assets. These are things that you own that will probably be used up within the year. So maybe some cash, different materials, goods, supplies, accounts receivable. So just to kind of show you this image here that's in your text, because I thought this was a good kind of visual. So you have your non-current or fixed assets, again, like land, the building, the machinery, stuff that's going to last you for more than a year. And then you have current or operating assets, cash, your bank balance, materials, goods, accounts receivable, all things that will be used up within the year. And we'll explain that a little more as we go on too. So moving on, we're going to talk about what some of your assets are during our next Class Connect. So a business kind of divides their assets up into different accounts. So maybe you have different savings accounts, and you're saving money for a bike or an iPad or new shoes, and so you kind of put money in these different accounts to save up for those different items. Well, same with the business. They have different accounts that they put money towards in order to buy different things for the account. You might have an office supplies account, a building account, a computer account, cash, accounts receivable. Accounts receivable is money that people owe you, so maybe they bought something from your business on credit. and they still owe you for that. That's called accounts receivable. We'll talk more about that later on. But so these are different types of asset accounts that we're going to be working with, because it's really important that we label our accounts and we know exactly which account we're taking money from and putting money into, and so on and so forth. Okay, so that was the term asset. So hopefully you're really familiar with that by now. Now we're going to move on to the term equity. Equity is the total amount of monetary value, keywords there, that you or a business owns. So, for example, and by the way, monetary is just a fancy word for money. So if you were to buy a $5,000 car, the amount of cash that you paid that went into that car is the $5,000. The car is the actual asset. So when you're thinking about the monetary value of your business, say the only thing you have your business owns is this car, then the car, your business, the equity of the business would be the $5,000. The asset would be the actual car. So again, so equity is the monetary value of what you or the business owns. Okay, the monetary value of what you own. So again, the car is the asset. The equity is the amount of that asset, so $5,000. There are different types of equity. There is capital or owner's equity, also known as internal equity. And this is the owner's contribution to the asset. So what the owner put forward as far as cash goes to obtain that asset. Then there is liability. This is external equity. This is an outsider's contribution to the asset. So let's kind of take a look of what a combined owner's equity plus external equity looks like. So for instance, let's go back to that buying that $5,000 car. So say that you put $2,000 towards the car, and then the remaining $3,000 you got a loan through the bank. So the capital or owner's equity of that car is $2,000. That's what we contributed, and we own $2,000 worth of the car. The rest, say we took out $3,000 from a loan through the bank, that is our liability. That is what we still owe for the car. So the car is an asset to the business. We have a equity investment of $2,000 into it, and we still owe a liability of $3,000 on the car. So lots of terminology being thrown at you right now. If you need to repeat all of this, by all means rewind the video and listen to all this again. But these are some terms you need to get really familiar with. Asset, described on the first couple slides. Equity, so what the monetary value of what we own. And now we're going to move into liability, which we just said liability is what we still owe for things. Okay, which brings us to the entire accounting equation. So this is the big equation that we're going to be working with during this course. So get familiar with it. Assets equals owner's equity plus liability. So every business transaction that we work with is going to affect this equation in some way. So what we need to always do, though, is make sure that it's always balanced, meaning that this side of the equation equals this side of the equation. And we're going to go over lots of examples on how to do this properly. So again, we want our assets to equal what we've invested into our assets and what we still owe on those assets. So again, assets could be cash in hand, accounts receivable, equipment, furniture, things that we own. Owner's equity is what the owner has invested, and liability then is what we still owe. Okay, so don't get too intimidated by this, because right now you haven't seen this in action yet, so don't freak out. We will go over it. But this page 7 in section 2 kind of describes this a little more, gives you some more information on it, so I suggest you read over it. We'll look at it together here. So the business transactions that we're going to be working with are going to affect this equation every time. So we need to these are the steps we're going to be taking for every business transaction. We're going to analyze the transaction in terms of if it's an asset, a liability, or owner's equity. Okay, what all is being affected with each transaction. Then we're going to decide on the effect of the transaction. So is it going to increase or decrease assets, liabilities, or owner's equity? Because remember, it always has to stay equal. So what we do on one side has to still be equal to the other side. Step 3, we'll then record the effect with the relevant side of the equation. So once we analyzed it and decided, okay, it's going to increase this account and decrease this account, we're going to record that transaction into the journal. Then we're going to balance the accounting equation after each transaction to make sure that it's still equal on both sides of the equation. Okay, so let's look at some examples from your text. I am on page 8 of section 2 in unit 3, if you want to follow along. So let's see if I can zoom in here a little bit. Doesn't want to do that. Okay, fine. So with this first transaction, Charlie started a business with $50,000 cash from personal savings. All right, here's the whole analysis process that we need to go through. This transaction increased cash on the left side of the equation and the owner's contribution on the right side of the equation. So going back to our equation, cash was an asset. Owner's equity is on the other side of the equation. Owner's equity is what the owner has invested. So when the owner invests $50,000 cash from personal savings, that's going to increase the cash balance and increase owner's equity or owner's capital. So both will increase by $50,000. So to show you the balance, the equation place cash on the asset side, the left side of the equation, and owner's equity on the right side of the equation. So again, he invested $50,000, so that increases our cash on the left side and it increases our owner's equity on the right side. So both sides of the equation are increasing by $50,000, so that means that leaves it equal. Okay? So that was business transaction 1. Transaction 2. Mr. Charles purchased land for $20,000 cash. So he had the money up front and paid $20,000 cash for a chunk of land. So the purchase of land creates a new asset while reducing the cash balance on the asset side. So cash is an asset and land is an asset. So they're both on the left side of the equation. The cash balance is decreased because he used that money to pay for the land, and at the same time the land is going to increase because that money went from cash to land. So the balance would look like this. Decrease in cash by $20,000, increase in assets or land by $20,000. So this is kind of what it's going to look like. Okay, this first line is the transaction of the $50,000 initial investment. So that was $50,000 that went towards cash and $50,000 that went towards owner's equity. There should be a $50,000 here. There's kind of some little misprints throughout your text, but there's $50,000 here, so that's balanced on our equation. And so this next transaction with the land, we paid $20,000 for it, so that's going to, you'll see that negative sign under the cash column. So we spent $20,000, we're just taking out $20,000 from our cash, and it's going towards our land. So you'll see both of these are an asset. So they're both under the assets columns, and we're subtracting it out of one and adding it into the other, still keeping our full equation balanced. So when we put both those equations together, you can see down here we have 50,000 minus 20,000 leaves us 30,000 left in cash, and then an increase in land of 20,000 gives us $20,000 down here. So 30 plus 20 is 50,000. And that stays equal to our $50,000 initial investment that we made in the business. So we're still balanced. Another transaction. Mr. Charles purchased materials for $5,000 and agrees to pay the supplier over an agreed upon period. So This type of transaction is known as a credit transaction. So Mr. Charles bought materials on credit for $5,000, which means, and buying on credit means you're going to buy now, pay later. If any of you took my personal finance class, you remember that from personal finance. So Mr. Charles agreed to pay the supplier in the future, so this makes it a liability because he owes that $50,000. So we have material, which is what he purchased. Material is an asset. And then we have accounts payable, so what we owe is a liability. So this is going to increase our materials by $5,000 because that's what we purchased, $5,000 worth of material. And it's also going to increase our accounts payable by $5,000 because we now owe that much to this company that we bought the material from. So the equation is balanced because we're increasing the asset side by $5,000 and we're also increasing the liability side by $5,000. So here's what that looks like. This was our previous transaction with the land and the $50,000 investment. So now we bought $5,000 worth of material, but we took that as a credit, so that increased what we owe by $5,000. So that still leaves, now we have $55,000 on this side and $55,000 on this side. So we still have a balanced equation. Okay, transaction 4. Mr. Charles sold part of his land for $10,000 on credit. Okay, so now someone else bought this land from us that with part of the buy now, pay later credit form. So Mr. Charles agrees to receive cash in the future period as an accounts receivable. So when we owe something, it's an accounts payable. When someone owes us, it's an accounts receivable, money that we can receive. Okay, classify both land and accounts receivable are asset accounts. And the effect will be accounts receivable increases by $10,000 and land will decrease by $10,000. We sold $10,000 worth of land, so that land account is going to decrease by $10,000. Whereas our accounts receivable, someone's going to owe us $10,000 for that land. And this is what that's going to look like. So we have $10,000 coming out of our land and $10,000 going into our accounts receivable. Again, both are assets, so they're on the same side of the equation. So in the very end, let's see if both sides of our equation add up. We have 30,000 plus 10,000 gives us 40,000, plus 5,000 is 45,000, plus 10,000 is $55,000 on this side of the equation. Then we have 50 plus 5, so $55,000 on this side of the equation, which means we're all balanced. Yay! So that's just a quick example of different transactions and how they affect the accounting equation. Okay, this next slide is the same equation, but we moved capital or assets over to this side and capital over to this side. Don't get too wrapped up in this. This just kind of gives us a quick view of the total investment into our business. So investment is the amount of capital or money put towards the business. So just by switching assets over to the right side of the equation and capital over to the left side of the equation and subtracting liability from assets, that gives us a good view of the total investment in the company. So the value of our business or our investment equals what we own, so our assets, what we own, minus the value of what we owe. So our total investment equals our total assets, or what we own, minus our total liabilities, or what we owe. For example, we have $60 to our name. Woo, we're rich. We owe our friend Tommy $20 for buying you dinner last week. So in actuality, you are only worth $40. And this is how it would look in equation. So we have $60, but we still owe Tommy $20. So technically, we're only worth $40. If that doesn't make sense, come to Class Connect and ask me questions. But that's just a really simplified view version of, again, a quick kind of look at our total value of investment. Okay, let's see. In other words, okay, property. So again, going back to assets equals owner's equity plus liability. This is just another way to show you the same accounting equation. Property is anything of value owned and controlled by the business. So property, and the term property and assets is going to be interchangeable throughout this course. And then financial claim is the legal right over your property. So that includes our owner's equity plus our liability are considered our financial claims. So even if we still owe money on the car that we took a loan for, we still have financial claim over that property. In other words, property equals financial claims. So I know this is a lot of equations thrown at you. It's really not as complicated as your text makes it sound, and once you kind of see it in action, so like with hopefully those transactions kind of made sense to you with the whole balancing of equations thing. And we will go over this even more in our Class Connect on Tuesday, so be sure to attend. This is the business equation practice assignment. Again, we will be going over this in class on Tuesday, so be sure to attend. And we will get you started and go over the first few transactions together so that you know what you're doing, and then I'll have you guys finish it on your own. And that will be it for this video. Again, this was sections 1 and 2 over Unit 3, and I will cover section 3 in a separate video. Okay, so let's take a look at some examples of all of this equation and everything. And oops, that was too much. And come on, an action here. Oh gosh.